Hello everyone, my name is Chris and thank you for watching my video on the finance simulation for capital budgeting that was created by the Harvard Business Publishing. This is kind of a confusing topic for me, as is accounting. It's one of the weaker points in my education, I would say. But I'm trying as best as I can, so bear with me and just stay along for the ride. So I'm doing the first simulation because it made the most sense to me. New Heritage Dial Company was the one I understood the most. So looking at my report, the revenue by division was mostly taken up by retail at 190 right here. And then production at 125 right here. And then by licensing at 24.5 right here. Something to point out, my APV from after seeing other people's videos and stuff is pretty low, but I feel like my simulation is pretty decent. Some things I looked at this whole time were these right here. These were probably the most three important things that had to do with the decision I made. Now going on, let's click on the operation profit by division. And as you can see, the operation profit by division is something else that I've looked at a lot. Licensing is something that made the most with just a little over 14%. And then production. Production had 5.39%. And retail was at the lowest at 309. I'm looking at the totals for this. It doesn't seem like a lot, but in reality, the company is just getting started, I would say. So let's move on to the total assets by division. And when you see that, the total assets by division, production is the highest in its category at 82, which is surprising to me because in all of the other categories, licensing is the highest. The second highest is the retail right here, and that's at 72.8, which I think is pretty normal. The last one in the category is licensing, and that's at the 10.72 mark right here, and that has been the highest one of any of them when you look at operations, when you look at revenue. So let's go back to the total assets by division. Let's look back at the APV right here. It's kind of low for a company that's supposed to be doing a large number, but this is something I struggled with most of the time during the simulation. I was pretty confused with this whole simulation, but the thing that stuck out to me was that we'll be talking about next. We're going to be talking about the income statement and the balance statement. On this page, you'll see very many numbers, projections throughout the years. We're going to focus on this first year. The current year is 2009. It is obviously the worst projected year due to the fact that it was the first year of the company's business. After reading the numbers, we will see which year was the best. You can see on the net sales that each year after the first year, the projections just get higher and higher each year. When looking at the earnings before income tax and net income, you can see each year right here. That's what we're talking about. You can see each year it just goes up little by little. And between 2016 and 2017, that's a good year. But I would say between 2017 and 2018, that's where your highest percentage of numbers come in at. Now, let's go to the assets. So we'll be talking about these numbers right here. One thing to look at first for me is there are a couple different sections that you want to look at. When looking at the first one on total assets, you see that it's 165.2. And each year, the business going up and each earnings coming in, your assets will go up. And I think between the year 2018 and 2019, that was the best year that this company has ever seen. Yeah, you could say between 2017 and 2018, that was another good year. But I think this year right here is the best, especially after looking at the net property, plant, and equipment. Those numbers kind of skyrocket, if you will. I'm looking at the first total asset. Look at the numbers in 2015. And from there, that goes up too. It's looking pretty good for the company, I would say. Next, we're going to shift gears and go to the cash flow statement and take a good look at that. I'm looking at all the years for the projections. Each year, I would say it climbs up more and more, which is good for the company. I would say the first thing you can look at for this page of the cash flow statement would be the total. Although it doesn't go up that much each year, I feel with the net income and the depreciation, I think if you were to stick with your company through 2019, it would go up after 2019 a lot. In 2009, it started at 26.06. And if you look at the projections for 2018, it climbs up. The next thing to look at is the cash flow from operations. I would say, although the first year doesn't look too good, I would say the last 5 years of the projections look pretty good compared to what they were in the beginning. Each year it goes up little by little. There's some risks involved in this section that made me feel a little bit uncomfortable, I would say. When looking at most of these numbers, there are a couple negative numbers you can see right here. And I would say that was kind of what made me feel a little uneasy about some of this project, was that looking at these negative numbers and them climbing about the same that these other numbers did, pretty much the whole page, I would say that's kind of what scared me of investing in this company. I felt more and more comfortable each time I changed the numbers. But I would say there's one risk I would say this section has as a cash flow from investments. Just because that's kind of it climbs pretty high between 2012 and 2013, and although this project is a low risk project, I would say that losing that much cash flow from what you invested is a pretty large number. But these numbers keep getting smaller and smaller through the year, and that's what was scaring me. Next, we can talk about the financial analysis. This page was kind of confusing for me as well to work through, so please bear with me on this one. One of the most important things I feel like I can point out that is very obvious to anyone that is looking at this page is the discounted cash flow. Right here, the number keeps going down, which I feel as if you're talking about a discount that it is better that the number would be going down, because then your number of saving money and making more money goes up. Something else to look at is the debt-free enterprise value. I feel like that number is very good right now. And then something else to look at would be the interest value, interest tax shields that go right here. And you can see in 2019, most of the numbers are going up. And I would say that would be good for your company. Now let's take a look at the product consolidated. I would say your numbers kind of look the same. If we go back to, I believe it is the dashboard, and look at the APV and go back to financial analysis, I feel like our numbers are matched up well. Each year throughout the projections, the numbers are just getting smaller and smaller. Like I said, the discounted rates just keep getting smaller and smaller, and I feel like that is good for the company. Now let's talk about the project details. When trying to find what I was going to do, I thought the Tyler Doll accessory line was going to be my best option. And then so the next thing I had to find was the discounted rate. And if you look right here, when putting in your numbers, it's going to tell you at a low risk. And then when you read this right here, the project involves a developing a new line of accessory carriages, cribs, carriers for an existing New Heritage Doll Company line. And the market target is toddlers, and the project is considered a low risk. I feel like it's considered a low risk because toddlers are always going to need the things that this company has. So now, when going to the NPV, this number right here, 6.8, I feel like that is a good place in the road to where your project discount rate and all of your other numbers line up good. Your IRR is kind of high, I would say. And that's, I would say, decent for what this company is trying to produce and what they are trying to do. Like I said, the discount rate is 7.85, and the payback period is 8.7, and the PI is 3.19. When looking at this first page, I would say there's a lot going on, so we're going to break it down a little bit. Looking at this project, I would say the first thing we will look at is the risk for this project. Like I said earlier, the risks are very low because the toddler market, because the target market is for toddlers, and there will always be a need for these types of items. Looking at all these numbers, I would say the one that we need to look at the most right here, or sorry, let me backtrack. Let's look at the lifetime project cost. That's a 3.14, and then your cost in 2010 when you first started the company is at a 2.14. So I would say this company is not going to cost you a lot of money to start up because of your earnings that you're going to make through the first years can protect you for the lifetime. One thing that stands out to me again is the NPV number right here. I think this number will increase profit because the state the company is in at the moment. Like I stated earlier, the IRR is 24.8, and I think that is a good staying number and will help play a huge role in the company being successful. Now let's scroll down a little bit and look at the terminal value number. Let's see, I gotta find it first. Right here, sorry, I was at the top. I think this number, if you look at it as a number, it's kind of interesting. The terminal value. I think when the net sales go up each year, actually, after the first year, And then looking at these numbers, I think it's pretty good. I mean, this terminal value number is what it is, and it's the estimated value of the assets we're talking about at the end of the first year, because everything else is just a projection. The IRR of the debt-free project, we kind of talked about that a minute ago. I would say that's pretty important right there because of the numbers, and it's a higher percentage that not a lot of the company has seen. But I would say that between the years of 2014 and 2015, the numbers go up for pretty much anything, especially net sales. We're going to talk about this row. If I were a businessman and I was looking at a company like that, I would think I was doing pretty good due to the fact that between 2014 and 2015, so right here, I think that was a pretty wicked sky jump for the net sales. And the number goes up the most and the company is more profitable. But I mean, I think that this is awesome for the company that after several years under the belt, they're making good money at a good, steady pace. So, also kind of another thing I've kind of looked at has been the net working capital. I think if you look at accounts receivable right here, that your numbers are going up, and with the APV I had, it's working out well. But also you can kind of see some of these numbers right here. Cash flow from operations and cash flow from investments are kind of starting to dwindle down, if you will. That's probably not a good thing, but let's move on to the next topic of the historical facts. And just kind of looking at this kind of just shows you what the company is trying to do, I guess you can say. Yeah, there are some numbers that don't look too well, but once you look into them, especially this net current asset, that's over half. And also the earnings before income taxes, or sorry, before interest and taxes. I feel like that's at a pretty good number. So if you look at the retail consolidated as well, those numbers are pretty good looking, I'd say. The 190 for the net sales is pretty cool. Now let's go to the licensing consolidated. If you look at the earnings before interest and taxes, it's at 14.45. And I think that's something that you need right there. So in all, I would say that I learned a lot from this capital budgeting simulation. I struggled with it, I would say, for sure. The company APB could have been a little higher, I would say, but in the end, I was trying as best as I could and hopefully did the right thing. Thank you for watching this video and have a good day.